It's a pretty lovely good evening once again from here in Delhi, and hope as always that each one of you are fine, happy, and of course in fine spirits. So now in this particular session on your demand, actually we are going to do a very comprehensive coverage of what we call all the MCQs. In fact, let me show you. This is my fourth volume. As you know, actually we are supplying 4 volumes to all those students who have subscribed to our courses. Now this volume is related to MCQs. As you can see, it's an MCQ question bank. And in this particular MCQ question bank, we have included all the questions which have been actually given in the question bank which has been actually issued by your institute. And besides that, we have organized them into chapter wise, and at the same time, all the questions which have struck and asked in the last 4 examination papers, and also all MCQs which have been given in your MTPs have been included. So now we shall start with what we call Ind AS 103, business combination, correct? So as far as Ind AS 103 business combination is concerned, in this particular case, first of all, just pay look over here, just pay attention over here. And now we are going to start the proceedings, correct? So this is your first question as it is written. It has been taken from MTP, and here it is stated that Ind AS 103 states that acquirer obtaining control over acquiry recognizes and measures in its consolidated financial statement at the acquisition date. As you know, whenever an entity acquires what we call other entity, the entity which acquires is known as acquirer entity. Now the question is asking that the acquirer company, which is obtaining the control over the acquiring company, recognizes and measures in its consolidated financial statement at the acquisition date. So for that, you need to know the accounting aspects. It is written over here, the identifiable asset acquired and the liabilities assumed at fair value. That is true, no doubt about that. And any non-controlling interest in the acquiry at fair value or at proportionate value. As you know that non-controlling interest can be measured at fair value or proportionate value. So that being, and finally it is also given goodwill acquired in the business or gain on bargain purchase. So on the date of acquisition, quite obviously these are the accounting aspects. So answer will be actually all of the above, correct? And further, in question number 2, now it is given that Q Limited acquired a 75% interest in R Limited on 1st of January 2023. On 1st of January 2023. And further, it is mentioned that Q Limited paid 900 lakhs. Q Limited paid 900 lakhs in cash for their interest in R Limited. So we acquired 75% interest in R Limited. And on 1st of January, we acquired the interest and we paid 900 lakhs in cash for interest in R Limited. The fair value of R Limited asset given to you is 2000 lakhs and the fair value of the liability is 920. Now what is the demand of the question? The demand of the question is NCI is valued at fair value and proportionate value. So you need to find out NCI at fair value and proportionate value. How you are going to find under this particular case? First of all, as you know, on the date of control, you need to find out the fair value of the net assets. Now, value of the asset given to you is equal to 2000 and fair value of liability you are going to subtract from it. So you are going to get the fair value, correct? This is the fair value of the net assets. Now, because you have acquired 75% control, and if you are going to compute 25% of this will deliver you value of NCI on PSNA approach, that is proportionate share of net asset approach. But question has also asked to compute what we call fair value, compute fair value of NCI. In order to compute the fair value of the NCI, how we are going to compute? For that, NCI at fair value. In order to know the fair value of the NCI, what we are supposed to do, first of all, I am going to write for 75% stakes, we have paid 900 lakhs. For 75% of the stakes, we have paid 900 lakh. That means this is the what we call fair value of total number of shares of the subsidiary company in proportion to 75%. So 75%, the amount which we paid actually is nothing but the fair value. So 75% of the fair value of total share capital of the what we call acquiring company is equal to 900. And now you can find out the fair value of 25% stakes. So this is how you are going to get the answer, and your answer will be equal to, that means NCI at fair value will be equal to 300 lakh and on PSNA basis it will be equal to 270 lakhs. Now We move over to the next question. Question number 3. Here it is written, X has acquired 100% of equity of Y Limited on 31st of 3, 2023. Further, it is given in the question that purchase consideration comprises of an immediate payment of 100 lakh and 3 further payment of 5 lakhs. It is a case of what we call deferred consideration. If you remember, we have done every concept, correct? So this should not strike you as a sort of surprise. Now, further, so far it is a case of deferred consideration, but we'll see actually ultimately it will become a case of contingent consideration because some conditions are also there. We are going to give you further 3 payments of 5 lakhs, correct? If the return on equity exceeds 20% in each of the subsequent 3 financial years. So it is a case of contingent consideration. As you know, on the date of control, we need to find out the total consideration, and in order to compute the total consideration, we will include the contingent consideration. However, here the question is simply asking you, and question has also given you discount rate of 20%, and further it is given that value of total consideration at the acquisition date. So we have to find out total consideration in this case. So our purchase consideration immediate payment is given. If you must have noticed actually this question is already there in our module. Anyway, so purchase consideration is 100 lakhs, and now I will have to find the value of contingent consideration, which I am going to include as a part of what we call consideration, correct? So in order to find out the value of contingent consideration, what will be the value of contingent consideration? You are going to pay 5 lakh at the end of the 3 years. So for that, what you need to do actually, you will have to multiply it with present value annuity factor at 20%. So at 20%, you are going to find out present value annuity factor for 3 years. Correct? So once you have the present value factor at your disposal, you simply multiply it with 5, and that will tell you the value at which you are going to include the amount of contingent consideration, and total amount ultimately will be considered as total consideration. Here I have done it for you actually. Your present value factor will be equal to 2.106. So you simply multiply 5 with 2.106 to know at what value you are going to include the contingent consideration, and then you are going to total it up to get your answer 110.532 lakhs. Is it clear to you? Now, in question number 4, it is stated in the question that Ind AS 103 states that acquirer obtaining control over acquiry recognizes and measures in its consolidated financial statement at the acquisition date. In fact, this question is similar to the one which we did earlier, correct? So answer will be your all of these. He will have to actually recognize, identify all the assets acquired and the liability at fair value. Obviously, he will take into account the non-controlling interest either at fair value or proportionate share basis, and besides that, he will take into account goodwill or gain on bargain purchase. Now, in the next one, the 5th one, it is stated that pooling of interest method. Pooling of interest method is considered to involve which of the following? So, under pooling of interest method, if you remember, we did it actually when we did the topic of common control, correct? Under common control, generally in the books of acquirer, we are going to apply the what we call pooling interest method. And under pooling interest method, as I told you earlier, the assets and liability of the combining entities are reflected at carrying amount. No doubt about that, it is absolutely correct. And second, the assets and liability of the combining entities are reflected at their net realizable value. No, this is not possible. This is not a feature of common control. No adjustments are made to reflect fair value or recognize any new asset or liability. If you remember, we did lots of questions with respect to common control. Over there, I told you actually that the acquirer company will take over what we call all the assets and liabilities at carrying value, and no new assets will be recognized. So we can say in this case A and C both. So your answer will be D. Here I have written 1 and 3. You can write it A and C. 6th one. How is non-controlling interest shown in financial statement? Obviously, the NCI, we have done lots of questions, especially under consolidation. And we have already seen actually that it is a part of equity, although it is written as a separate line item. So your answer will be, it is shown as an item of under the equity. It is written how you are going to actually reflect it in the balance sheet. As per Ind AS 103, according to accounting and reporting of the business combination is done as per acquisition method. No doubt about that. And pooling interest method is applied as per appendix, not as per Ind AS 103. It is applied as per appendix, which is attached to what we call Ind AS 103. When after the business combination acquiree cease to exist, it is to be recorded in the books in one set only. I have already told you so many times. For example, there is an entity E1 and it takes control of E2. It takes control. Let us say we have acquired 70% stakes in E2. Obviously, we are the acquirer company and E2 will be considered as acquiring company. So many times I have already told you, control can be acquired either through majority stakes, correct? When you acquire what we call more than 50% of the share in the investee entity, obviously now control is going to lie in your hand. Besides that, you can also get control through agreement, which I explained when we did actually business combination, especially in the initial stages, correct? Especially when we have the right to compose the board of directors of the investee entity, or when we have the what we call through agreement right to take care of what we call all the relevant activities. So control can be acquired either through majority weights or what we call through what we call agreements. Now, control can also be acquired in this manner. For example, there is an entity by the name of E1 and there is another entity E2. Now, this time actually we are, let us say, taking over all the assets, all the net assets of E2. So in this way also control can be acquired, but the important point is that in this case now E2, the existence of E2 will cease to exist. Now E2 will not be operating entity now because we have completely taken over their net assets and liabilities. So in this case, acquirer company will not prepare any consolidated financial statement. When the existence of the investee entity will come to an end, obviously there is no question of any consolidated financial statement. So in this case, we are going to actually do the accounting only in our standalone financial statement. Separate financial statement, you can say, or separate alone financial statement. So when after business combination acquiring company cease to exist, it is to be recorded in the books of acquirer in one set only. In one set only means in the separate financial statement, also known as standalone statements. So because in this case now investee entity's existence has come to an end, so no question of any consolidated financial statement. Now we move over to 9. Now in this case, it is written Ind AS 103 has a wider scope. First of all, you need to know actually that Ind AS 103 is corresponding to AS 14. It is corresponding to AS 14, and quite obviously Ind AS 103 has a much wider scope. So that is why your answer will be this one. In question number 10, it is being written that at what value non-controlling interest is recorded in the books of the acquiring company at the time of business combination. I have already told you, now this question should not pose you any difficulty. Correct? Either it is recognized on PSNA basis, that is proportionate value of what we call net assets, or what we call at fair value. So your answer will be D. In 11th, it is written that A Limited acquired 80% shares of B Limited for 12,80,000. So there is an entity by the name of A Limited, and this time it is taking over B Limited, and we are getting 80% control. And we are paying a consideration of 12,80,000. 12,80,000. Now fair value of B Limited's net assets at the time of acquisition is equal to 14,50,000. So on the date of control, fair value of net asset is given to you as 14,80,000. 14,80,000 is the value of net assets of B Limited. It is given to you, and here it is written non-controlling interest are recognized at fair value, and you need to find out the value of non-controlling interest. So question is not asking you to compute the amount of goodwill, simply asking you to actually find out the value of non-controlling interest at fair value. So in order to find out NCI at fair value, simply first of all you write for 80% stakes you are paying consideration of 12,80,000. Correct? So actually when we say for 80% we are paying 12,80,000, what does it mean? It means actually in practical life, when a particular company takes over the other company, first of all we check the total fair value of the total share capital of that particular company, of the investee entity. If suppose I am getting 80% stakes in the investee entity, how much I am going to pay. Generally, the rule is that whatever share capital of investee entity and whatever its fair value will be, and proportionate control is 80%. So this much amount actually I am going to pay. So that is why I am saying here that for 80% control, the fair value will be considered at 12 lakh 80. So quite obviously now I need to find out the value of 20%. So whatever 20% value will be there, you are going to write it over here, and your 3,20,000 will become the answer. Now the next one is actually on 1st of January 2023, P Limited acquired 80% of the equity interest in Q Limited. And further it is written that you are issuing what we call shares of rupees 50 lakh, and their market value actually is 120 lakhs. So point here is that you are acquiring 80% control in Q Limited, and for that you are issuing equity share which are having a paid up value of 50 lakh, but their market value is 120 lakhs. So indirectly your purchase consideration so far is actually 120 lakhs. The identifiable assets are given to you are measured at 190 lakh. This is also given to you in the question, and liabilities are worth rupees 30 lakhs. So that means on the date of control, it is given to you that fair value of the asset is equal to 190 lakh, while the value of liability is equal to 30 lakhs. So that means the net assets fair value of net asset is equal to 160 lakh. But what exactly the question is asking, it is of paramount importance, especially in the examination, to go through the entire length and breadth of the question before you start. Because often I have seen actually students simply read this much of information and start what we call computing goodwill. Nothing like that. In this case, non-controlling interest is measured at proportionate net assets value. So this time question is not asking you to compute NCI. Information is given that NCI is being valued on PSNA basis, but question now is asking you to compute the gain on bargain purchase. So how you are going to compute the gain on bargain purchase, I need not require to tell you. So first of all, you are going to find out the value of the net assets. Now out of this net assets, you simply find out the asset which are belonging to NCI, because NCI is to be computed on PSNA basis. You simply take 20% of this. So we may say actually that 32 lakh worth of net assets belong to NCI, and the balance of the asset belong to actually acquirer entity. So on the date of acquisition, out of total net assets, share of acquirer will be 128 lakh. So we may say that when we actually acquire the control, acquirer got hold of actually 128 lakh worth of net assets, and we are making a payment of 120 lakhs. So this time the amount of consideration is lesser than what we are getting. So there is a gain of 8 lakhs. So your answer will be equal to 8 lakhs. And similarly, now in next question, it is given to you that on 1st of January 2023, M Limited acquired 80% of the equity interest in P Limited. Similar to the last question also, in this question, it is written that paid up value is actually 200, but the market value is 480 lakh. And the identifiable net assets are measured at 760 lakh and liabilities are 120 lakh. Similar to the last question, here it is written that compute non-controlling interest if it is measured at net asset value. So in this particular question is not asking you to compute the amount of goodwill or gain or bargain purchase. You are simply supposed to compute the value of the NCI, and I need not require to tell you what will be the value. So in this case, on the date of acquisition, first of all, you are going to take into account the fair value of the net assets. So fair value of asset is given to you as 760 lakh, and you are going to simply subtract fair value of liability. So whatever figure you are going to get, I think it will be equal to 640. So you simply what we call now compute 20% of it, because you have got the control of 80%. So on PSNA basis, NCI will be equal to this much. So in this case, your 20% of 640, I think it will be equal to 128 lakhs. So your answer will be 128 lakhs. Is it clear to you? Actually, best way to do MCQ is that you need to have a very in-depth study of each chapter. If you have done every chapter in an in-depth manner, in a penetrative manner, in a very potent manner, obviously speaking, you need not require to actually do MCQ separately. correct? And many students are under a phobia that if you are going to do 10,000 questions, then they will become proficient in it. No, nothing like that. First of all, you need to have very formidable conceptuality of each chapter. But anyway, now let's move further. Now, this question we have already covered, especially in the recent examination and in our regular classes also. This question, similar question, same question which we did. If you remember, we talked about what we call business combination in stages. And I told you lots of questions are being asked from this particular topic. So in this case, and some of you might remember it actually, that entity A acquired 35% of entity B on 1/4/2023 for rupees 35,000. So since we have got control over this particular entity only to the extent of 35%, so we are not having the control in real sense right now. But it is stated that on 31st/3/2024, fair value of shares of entity B is equal to 42,000, thus 7,000 reported under OCI. What does it mean actually? If you remember, now in this question, accounting year is starting from 1/4/2023, first of all, and it is ending on 31st/3/2024. Those among you who haven't actually subscribed to our courses, for them actually I'm telling 35% of the stakes we acquired on this particular day. 35% stakes, and consideration which we delivered to acquire these shares is equal to 35,000. Now further, when we reach the end of the accounting year, it is stated that the value of these shares now is equal to 42,000. Obviously, your investment which you have done in your associate, because right now this particular entity B Limited is your associate entity because you have investment in that particular entity in excess of 20% but less than 50%. So right now, presently, entity B is your associate entity, you may say so. Now, initially, you acquired 35% stakes and you paid actually 35,000. That means investment in associate right now is equal to 35,000, but its fair value has jumped to actually 42,000. Now, it is also given in the question that this gain of 7,000, obviously this gain is there to the extent of 7,000, and it is given in the question that this gain was recorded in OCI. I have already talked about this particular fact in our regular classes and in the revisionary session also, that this gain can be actually taken to OCI or it can be taken to P&L. If nothing is mentioned in the question, always take this gain to the P&L. But since it is given in the question that this gain was reported in OCI, that means your entity, this entity must have passed this particular entry on this particular date, 31st/3/2024, investment in B Limited account. Now your investment is moving up by 7,000, so you are going to debit your investment and the gain is taken to other comprehensive income because it is given in the question. Now if this line would not have been given in the question that gain was reported in OCI, I would have taken it to profit and loss account. Is it clear to you? So important point is that your investment now has gone up to actually 42,000. Now further, it is given on 1/7/2020. On 1/7/2020, in fact, it should be on 1/7/2024. Correct? On 1/7/2024, entity A further acquired 40% stakes in B Limited. Now your next year starts. In the next year, what is happening? Your next year will start from 1/4/2024 and it will end on 31st/3/2025. It will end on 31st/3/2025 quite obviously. Now, it is given that on 1/7/2024, on 1/7/2024, A Limited acquired further 40% stakes in B Limited. Since earlier you were having 35% stakes, now because of this additional investment, now you are having the control. So that is why it will be considered as a case of business combination through stages. It is also known as step acquisition. Is it clear to you? So business combination through additional investment, in this case you are getting the control. So that is why it is a case of business combination in stages. So presently now you are having 75% of the total what we call stakes and 25% is the share of non-controlling interest on this particular date. Is it or not? Further, it is given that B Limited paid a consideration of 60,000. So when you acquired 40% additional stakes, for additional stakes you made a payment of 60,000. Further, it is given that entity A identifies net assets of B Limited at a fair value of 1,20,000 on the acquisition date. Now on the acquisition date, it is also given that fair value of the net assets of B Limited is equal to 120 lakhs. Sorry, 1,20,000. This is also given in the question. Further, it is given that value of 35% stakes has now gone up to 45,000. Remember one thing, your initial investment was 35%, and this value has already gone up to 42,000 by this particular date, and you have already recorded it. Now question says that on 1/7/2024, this investment has gone up to actually 45,000. So on 1/7/2024, you will have to pass another entry. And in fact, you are going to pass the same entry. So I'm simply writing here investment in B Limited account debit to OC account, and this entry will be by rupees 3,000 because now the value of your investment has gone up to 45,000. Is it clear to you? Now, question here is not asking you to compute the amount of goodwill. Question is not asking you to compute the amount of goodwill. Question is asking you what amount you are going to transfer to profit and loss account. Actually, now what is happening, whatever amount which you have taken to your OCI, because earlier this company was your associate and now this company has become your what we call almost subsidiary company because it is under your control. So quite obviously now we will have to cancel our original investment, and whatever gains which we have taken to OCI will be retransferred to profit and loss account. Actually, answer to this particular question will be that 10,000. Ultimately in profit and loss account there will be 10,000 because total gain which we have recorded in OCI is equal to 3,000, and this gain will be reclassified to profit and loss account, and our entry will be OCI account debit to P&L account, that is equal to 10,000. Actually, this is the entry we are supposed to pass in this particular question. Now, suppose in this question I would have asked you to compute the amount of goodwill, how you would have computed. In order to find out the amount of goodwill, first of all, I would have checked net identifiable asset on the date of acquisition, on the date of control as we call it. Now, actually the control was acquired on 1/7/2024. So on this particular date, it is given that the net assets of what we call B Limited is equal to 1,20,000. So I will write here 1,20,000. And out of this 1,20,000, first of all, I am going to pluck out the share of NCI. Now, NCI is equal to 25% because 75% shares are in our hand. So, if I am going to compute what we call 25% of 1,20,000, it will be equal to 30,000. Now, remaining net asset actually belong to acquirer company, no doubt about that. Remaining net asset belong to acquirer company, but we must not forget, this time we cannot directly compute the amount of goodwill. As I told you, actually in order to compute the goodwill, especially under business combination achieved in stages, we have to be careful. We directly simply cannot now compare this 90,000 with the amount of consideration. First of all, I will have to check on the date of control what exactly is the value of my previously held investment. So here I am going to write here value of previously held investment. VOPHI, value of previously held investment, as it is given that on 1/7/2024, value of your previously held investment is 45,000. What does it mean actually? Out of these 90,000 worth of net assets are accruing to the acquirer entity on account of previously held investment. Now, if I am going to subtract 45,000 from 90,000, I will be left up with 45,000. This 45,000, what does this 45,000 suggest? This 45,000 suggests that on account of additional investment of 60%, we are getting hold of 45,000 worth of net assets. So now I am going to compare it with the what we call consideration which we have paid, and the consideration which we have paid is equal to 60,000. So your goodwill in this case will be equal to 15,000, although it is not asked in the question. Now we move over to question number 15. In this question, it is stated that D Limited has acquired 100% of equity of F Limited on 31st of March 2023, and the purchase consideration comprises of immediate payment of 10 lakh and two further payment of 1.21 lakhs if the return on equity exceeds 20% in the subsequent 2 years. Now this question is similar to the one which we did earlier. Again, it is a case of contingent consideration. So your total consideration will be, you are making a payment of 10 lakh. This is obviously you are paying as immediate amount. So 10 lakh obviously you are going to consider as part of purchase consideration. Besides that, you are going to take into account the present value And generally we write actually provision for contingent consideration. We write it this way, provision for contingent consideration. It will also be made part of what we call consideration, and this will be your total consideration. So we have to find out the present value. In order to find out the present value, what you are supposed to do, you will simply take 1.21 lakh, which you are supposed to pay after 2 years. Now you will have to take into account what we call present value factor, present value annuity factor for 2 years, which I have written over here. See here, present value factor at 10% for 2 years I will take into account. So whatever that factor is there, you multiply it with 1.21, and that will be equal to 2.10. That means 1.21 into present value factor, present value annuity factor at 10% for 2 years. So you are going to compute that particular factor, and whatever that factor is there, you multiply it with that one, you will get 2.10, and your answer will be equal to 12.10. Now in question number 16, even this question has been directly taken from what we call study material. On 1/4/2020, Gold Limited acquired 75% of Coal Limited. So this time actually Gold Limited is taking control of what we call Coal Limited, and they are taking control to the extent of 75%. Further, it is given when fair value of its net asset is 10 lakh. So it is given in the question that on 1/4/2020 you are taking control of what we call Coal Limited. It is also given that value of net assets of investee entity on the date of control is equal to 10 lakhs. This is also given in the question. So this total net assets of the investee entity, acquiring entity on the date of control is this much. Further, it is given that during 1/4/2022, actually this date should be, there are some problem with respect to date. Anyway, 1/4/2022. It is given from 1/4/2022 to 31st/3/2023. So when this accounting year ended on 31st/3/2023, it is given Coal Limited made a profit of TCI, means total comprehensive income, and total comprehensive income is nothing but profit. So total profit earned by your acquiring company is equal to 2 lakh during the year. Correct? Now it is given that on 31st/3/2023, Gold Limited, name of acquirer entity is Gold Limited. Now Gold Limited purchased 15% holding from the outsiders at 2,20,000. So this time acquirer company, even though it is having a control, it is acquiring some additional shares, and acquiring additional share for 2,20,000. Question is simply asking you to actually compute gain or loss to be credited to other equity. Obviously, whenever there will be loss or gain on account of purchase or sale of what we call shares, additional shares, so in that particular case, we take it to the other comprehensive income or the other equity. And now, first of all, how you are going to compute the amount of gain? First of all, you need to know when you are purchasing the additional stakes. You are purchasing the additional stakes on this particular date on 31st/3/2023. So you need to know what total amount of net assets on this particular date. Now, total amount of net assets on this particular date will be equal to this much. You simply, because you had, or your investee entity or your acquiring entity initially was having a net assets of 10 lakh, and now they have got a profit of 2 lakh. So by the end of the year, their total net assets will be considered equal to 12 lakh. Is it clear to you or not? Now, on this particular date, we are acquiring 15% additional stakes. So I will simply compute the 15% of 12 lakh. So 15% of 12 lakh, it will deliver me the value of the shares which I am acquiring. Are you getting my point or not? So the value of share, if I am going to compute 15% of 12 lakh, will be equal to 1,80,000. So that means the 15% stakes actually which I am acquiring, and value of net asset is equal to 12 lakhs. So that means total fair, because these are the total net assets of the investee entity. So fair value of total net assets indirectly also means total fair value of the share. So we are getting 15% shares. So value of the 15% share is 1,80,000. And how much amount actually you are paying to acquire the same? You are making a payment of 2,20,000. So obviously there is a loss to you, and loss amount will be equal to 40,000, and it will be taken to OCI. Correct? In question number 17, it is stated, as per Ind AS 103, while accounting and reporting for business combination, goodwill is calculated as. Now here some of you may face problem. Why you may face problem when you especially go through this particular question? Because we have a habit of computing goodwill in this manner. First of all, we take into account the net assets, then generally we take into account the share of NCI. Then whatever remaining net assets are there, we presume that these net assets now belong to the acquirer, correct? And then we compare it with the consideration to get the what we call amount of goodwill or gain on bargain purchase. This is the methodology actually which we have adopted. But since in this question it is given, now whenever an MCQ question is going to ask you in such a manner to find out actually how you compute the goodwill, it is always better in your rough somewhere you write the entry actually, what entry you write. Because we know that goodwill can be derived through entry also. All the asset taken over to liabilities taken over, correct? To NCI, to consideration. And if you have previously held investment, then we also write to previously held investment. So now you will be in a better position to know actually which will be your answer. Now, because it is given that consideration plus non-controlling interest, we have written non-controlling interest and consideration on the liability side, it is correct, and minus net asset. Net asset means assets minus liability. So this will be our answer. Is it clear to you or not? So we can derive the formula through this particular entry very easily and reach the conclusion. 18th, on 31st of March, A Limited absorbed B Limited and issued 60,000 shares of 10 each, which were trading at rupees 25. So 60,000 into 25 will be your consideration. It is given that book value of the net assets of B Limited is 12 lakh. Equity share capital of B Limited is 5 lakh and other equity is 7 lakh on this particular date. The fair value of net assets of B Limited was assessed at something is missing in this question. Okay, it is given that the fair value of net assets were assessed at rupees 13 lakh. This sentence got repeated, correct? You cut this particular line. The sentence is fair value of net assets of B Limited is actually 13 lakh and the amount of consideration. Question is not asking. They are simply trying to actually see how much attention you are going to pay. More often than not, chances are very much there in the examination that in the heat of anxiety, a student without going through the entire or without looking into the question, what exactly the question is for, they simply will start computing the amount of goodwill. Question is simply asking you what is the amount of consideration. So your amount of consideration will be 60,000 into 25. That is all. So your answer will be equal to 15 lakh. Similarly, in this particular case, it is given Q Limited acquired 60% interest in R Limited on January 1st, 2023 and Q Limited paid 900 lakh in cash for their interest in R Limited. And the fair value of R Limited asset is equal to 2,000 lakh and fair value of liability is equal to 1,000 lakhs. If NCI is valued on net assets basis, you have to find out goodwill, and that should be almost like a stroll in the park for you. Now, in this question, first of all, you simply take into account the net assets, fair value of the net assets. Now, it is given in the question that fair value of R Limited asset is equal to 2,000 and fair value of liability is equal to 1,000. So that means the fair value of the net asset is equal to 1,000. Once you have value of net asset, now you simply take into account the share of NCI. It is given that NCI is being computed on PSNA basis. 60% is your stake. So what will be the stake of 40%? So 40% into 1,400. So we may say that 400 worth of net asset belong to NCI. So what will be acquirer share? The acquirer share will be equal to 600. So our share is 600 and we are making a payment of what we call 900 lakhs. So consideration amount, PC amount is higher. So 300 will be your answer and 300 will be your goodwill. Is it clear to you? Similarly, in question number 20, it is given that A Limited takes over B Limited for 12,60,000 and fair value of B's net asset at the time of acquisition amounted to 11,80,000. Calculate the amount of goodwill. Now, in this question is simply asking this much, that you are taking over B Limited and you are making a payment of 12,60,000. You are making a payment of 12,60,000. Correct? Okay, if I am going to do it in this manner, net identifiable asset. Net identifiable asset given to you 11,80,000. Generally, we have a habit of finding out what we call NCI. In this question, you need not require to find out NCI because it is given directly in this manner. If you remember, in our regular classes, we stressed upon this particular point that whenever controlling interest or controlling stakes are not given in absolute terms, always presume it is a case of 100% control. So that is why NCI will be considered 0. All the net asset will be considered as belonging to what we call acquirer, and you are going to simply compare it with the amount of consideration. So amount of consideration is higher, so the difference of 80,000 will be considered as goodwill. So that is why in this case 80,000 will be considered as goodwill. In question number 21, it is given to you that on 1st of January 2023, A Limited acquired 80% of the equity interest in B Limited in exchange of cash of rupees 600 lakhs. The identifiable net assets are measured at 925 and liabilities are measured at 150. So 925 minus 150 will be your net assets. Fair value of 20% non-controlling interest is 90 lakh, and fair value is already given in the question. So don't commit this mistake of computing the NCI. So all you have to do is, first of all, question is asking us the gain or bargain purchase. So first of all, we need to know the net assets on the date of acquisition. As we can see that identifiable asset is equal to 925 and liabilities are measured at 150. So you have been able to find out the value of the net asset. This will be the value. Now, value of NCI is already given. Now, value of NCI is given in the question, 90 lakhs. It is given already. So, whatever value now you have got, out of that 90 lakh belong to NCI. So, the remaining net asset will belong to acquirer company. And now you simply compare it with the amount of the consideration. The amount of the consideration is actually 600 lakh. And then resultant figure, depending upon the fact whether PC is higher or lower, will be what we call your answer. Ultimately, in this case, 85 lakh will be your gain on bargain purchase. In question number 22, it is given that A Limited acquired 80% of B Limited for rupees 10 lakh. And consideration was paid by equity at par, and fair value of B's net assets at the time of acquisition amount to rupees 9 lakh, and the value of goodwill based on NCI valued at fair value of identified net assets will be. Value of goodwill. This time actually question is asking you to find out the value of goodwill, but indirectly they are trying to tell you that NCI is being valued at fair value of net identified asset. In simple words, NCI is being measured at what we call fair value. So for that, you need to first of all write the amount of net assets. And the fair value of net asset given to you is equal to 9 lakh. Once you have determined the amount of net assets, then you simply take into account the stakes of NCI. But NCI you will have to find out on fair value basis. In order to find out on fair value basis the value of NCI, first of all take into account the stakes. For 80% stakes you are making a payment of 10 lakh. So for 80% the fair value will be considered as 10 lakh. So what will be the fair value of 20% stakes? So whatever value you are going to get, correct, 20 into 10 lakh divided by 80, whatever value you are going to get, you write it over here, take the balancing figure. Now compare this balancing figure with the amount of consideration. Consideration is given to you as 10 lakh, and then you can get your answer. In this case your answer will be equal to 2 lakh 80. In 23, it is given that A Limited acquired 80% of B Limited for 12 lakh 80, and this is the same question actually got repeated. 24, MTP, C Limited has acquired 100% of equity of W Limited on 31st of March 2021. The purchase consideration comprises of an immediate payment of 15 lakh and two further payment of 3.63 lakhs if the return on equity exceeds 18% in each of the subsequent financial year. So that means because it is given that you are going to make a payment of 15 lakh immediately and two further payments. So similar to the question which we have done, lots of questions on contingent consideration are asked in the examination. Discount rate 10% is being given. Analyze the above information in the light of Ind AS 3 to find out the value of total consideration. Obviously, for total consideration, whatever payment you are making immediately 15 lakh, now you will have to find out the present value of the contingent consideration. In order to find out the present value of the contingent consideration is 3.63 lakhs. Now you will have to multiply it with present value annuity factor, correct, at 10% for 2 years. For 2 years. So whatever factor is there, you multiply it with this one and add the figure to the 15 lakh to get the answer. So ultimately your answer will be equal to 21.3 lakh. 15 lakh is the immediate payment and 6.3 lakh will be the amount of consideration which we are going to actually include. Correct? It is clear to you. So all these questions are related to business combination and lots of questions have been asked as MCQs from what we call business combination. Now we move over to this particular chapter, Ind AS 110. Consolidated financial statement. Honestly speaking, the question which we have just discussed under Ind AS 103, same question can be actually discussed under this particular what we call chapter. For instance, if you are going to have a look over here, on 1st of January 2024, A Limited acquired 80% of B Limited in exchange of 600 lakh. Now, this is the same question which we just did a while ago. The identifiable assets are measured at 925 lakh, liabilities are measured at 150 lakh. And the fair value of 20% stake is 90 lakhs. So this question which we just did under business combination, same one. Now, question number 2 is quite interesting. Here it is written that consolidated financial statements are required to be prepared by an Ind AS compliant company if it holds shares in the investee entity. Question is asking you directly or indirectly. Question is asking you when consolidated financial statement need to be prepared by an entity. Those among you who have actually attended our regular session and revisionary session should not have any difficulty in answering this particular question because we gave you in the very initial stages, both under regular sessions and under revisionary sessions regarding what we call this, lots of information. Here it is given entailing 20% or more voting rights and having significant influence. Indirectly, it means if suppose you are an entity and you are having 20% stakes in the other entity, the other entity is investee entity. I will simply write other entity. So first of all, as we know, in this case, entity E1 will be called associate. And I told you, if you are having, this entity, investor entity, and this entity is having 20% stakes in this entity, so this entity will become your associate entity. So if investor is having an associate entity, even in this case, we are supposed to prepare consolidated financial statement besides the separate financial statement. So yes, this will be considered. And B, entailing joint control over the investee company called a joint venture as per Ind AS 28. If you remember, I also talked about this particular point that if there is an entity and we are having a joint venture, we have made some investment in the other entity and this other entity, let us say, is a sort of joint venture. Even in this case, we are supposed to prepare the consolidated financial statement. Is it clear to you? So, entailing control over the investee company, and investee company is our subsidiary company, that means we are having more than 50% stake. So in this case, your answer will be all of the above. That means in all these situations, the investor entity will have to prepare the consolidated financial statements. Correct? And now here it is written on 31st of March 2027, A Limited absorbed B Limited, issued 60,000 shares that were trading at 125. You must have noticed actually the same questions which were tossed up under Ind AS 103 have been asked over here also. So you should be in a position to answer this because we have already done this particular question just a moment ago. Your question is simply asking the value of purchase consideration. Now fourth one is an interesting one. Correct? An investment, what is an investment entity? Remember one thing, investment entity are considered as an exception to the preparation of the consolidated financial statement, correct? So, an investment entity is an entity that obtains funds from one or more investor for the purpose of providing those investor with management services. That is very true. commits to the investor that business purpose is to invest the funds solely for the return of capital, appreciation, investment income, or both. Again, this is a feature of what we call investment entity, and it measures and evaluates the performance of substantially all of the investment on fair value basis. Yes, all these are characteristic of an investment entity, and so your answer will be all of these, but important point is that if there is an investment entity, then it need not require to actually prepare the consolidated financial statements. Fifth, requires that when consolidated financial statements are prepared by the investor companies shall also prepare the individual standalone financial statement which are named as separate financial statement. Actually, this question belongs to Ind AS 27. Ind AS 27, one paragraph is also given in your module along with Ind AS 110, and we have also talked about this during our regular sessions, that, and especially in the very first session I have talked about all these points. As per Ind AS 27, whenever we are supposed to prepare the separate financial statement along with the consolidated financial statement, then separate financial statement need to be prepared in accordance with Ind AS 27. And also, just to remind you, I also told you that Ind AS 27 states that separate financial statements, basically when we prepare and especially when we write over there our investments in associate or what we call subsidiary company, etc. Correct? So such investments can be recorded at cost or at fair value in accordance with Ind AS 109. This is the theme of Ind AS 27, that in the separate financial statement, whatever investments are there, whether in associate or in what we call subsidiary company, those investments can be accounted for either at cost or on fair value basis in accordance with Ind AS 109. Is it clear to you? Anyway, here the question is, your answer will be Ind AS 27. This is the same question which has been repeated correct earlier, so you should be in a position to answer this particular question. Now we move over to chapter 3. This is Ind AS 102. Actually, I need not require to do this particular question because at great length we have just given you revisionary session regarding this, but still, share-based payment. Now in this particular case, question number 1 states that entity X grants 10 share each to 1,000 employees on the condition as mentioned below. To remain in service, an entity's profit after tax shall reach 100 million. So there is an agreement between the what we call entity and its employees, wherein entity is telling to the employees that we will allot you 10 shares of 1,000 each, but at the same time there are some conditions that they need to stay in the service, and entity's profit after tax must actually reach rupees 100 million. Further, it is given, it is expected that profit after tax should reach 100 million by the end of the 3 years. That means at least for 3 years, the employees will have to stay in the organization, and within next 3 years, the profit target should be 100 million. Fair value on the grant date is 100 lakhs, and it is given that employees are expected for vesting right by the end of the first year 97%. So this entity is expecting that by the end of the first year that only 97% employees are going to actually complete the service period, and similarly it revises it to 95% by the end of the second year, and finally to 93% by the end of the third year. Now what is the demand of the question? Calculate the expenses to be recognized in year 3 in respect of share-based payment. Now in this case, how you are going to recognize the expense? So first of all, for instance, in year 1, if I am going to do the computation here, in year 1, now you presume you are the accountant of this particular entity. Now you have 1,000 employees. How many employees you are having? 1,000 employees it is given, and as per your agreement with the employees, you are supposed to issue 10 shares. 10 shares, correct? And the fair value on the grant date it is given to you in the question is rupees 100, so you are going to multiply it with rupees 100. Now this is the total value of the compensation, but important point is that you are expecting only 97% employees are going to actually complete the scheme, so that is the reason you will have to multiply it with 97%. So when you will reach at the end of year 1, you will be under an impression that this will be the total amount, which the entity will have to actually spend. So this is the total amount. But how much you are going to recognize in the first year. Recognition, you are going to recognize 1/3 of this figure. You will take 1/3 of this figure, correct? So this much amount you are going to recognize, or you are going to book this much of expenses in the first year, isn't it or not? Similarly, now when you are going to reach the end of the second year, in this second year, you are going to do the calculation in the same manner. Actually, you are having 1,000 employees, you are offering them 10 shares each, grant value is 100, but at the end of the second year, now you think that only 95% employees are going to cover the scheme. So that means now you are under an impression that total expenses ultimately will amount to actually this much. So how much you are going to recognize? So cumulative recognition, that means in the second year, first of all, you are going to compute what of this amount you are going to compute 2/3. Correct? This is the total amount which you are going to actually book by the end of the second year, but you will have to subtract the previously recognized figure. This previously recognized figure will be subtracted to know actually what amount you are going to book. The difference between these two, this is the amount which you are going to book in the second year. Is it clear to you or not? Now, similarly in year 3, when you are going to reach year 3, your total expenses 1,000 into 10 into 100 into 89%. I think it was 89% or 93%, not 89. By the end of the third year, it was estimated that only 93%. So ultimately, your expenses amounted to this much, correct? So whatever figure this you are going to get, out of this figure, you simply subtract the expenses which you have booked in the first year and in the second year, and this will be your answer. Is it clear to you? I have already delivered the answer here. All the items, all the figures which have been written in bold are your answers. Is it clear to you? So you should be in a position to do this particular question quite easily. And similarly, now question number 2, an entity actually issued 100 shares of 1,000 employees. This question is similar to the last one. 100 shares this time instead of 10. Actually 1,000 employees are there, and the service condition is that they need to stay in the organization for at least 2 years. And grant date fair value of the share is 195. And there is an expectation that 97% of the employee will remain in service at the end of the first year. So at the end of the first year, you are estimating that only 97% employees are going to actually complete the terms. And however, at the end of the second year, the expected employee to stay in the service will be only 91%. Actually, question is asking you calculate the expense for the first year, not for the second year. So that is the reason actually you have to be careful to go through the entire what we call length and breadth of the question. So in this particular question, you are having 1,000 employees and you are offering them 100 shares, and grant date fair value is actually 195. But although this will be your total expense, but you are expecting that only 97% employee are going to complete the scheme. So total expenses will be this much, and you divide these expenses by 2 because only 1 year has gone by. So total amount which you are going to recognize in the first year will be equal to this much. So this is the amount which you are going to recognize. This will be your answer, and answer will be equal to 94,47,300. And in question number 3, it is stated that an entity issued 100 shares to 1,000 employees subject to service condition of 2 years. Same question, but this time question is asking you to calculate the expense for the second year. Because figures are same, so I can use these figures. And in the second year, I am going to recognize an expense of this much, 100 to 1,000 employees into 100 into fair value, that is equal to 195. But in second year, we are expecting only 91% employees are going to cover the scheme, 91%, correct? So that is why I am going to multiply it with 91%. So total expenses by the end of the second year will be equal to this much, correct? So whatever expense we are going to get, I will subtract the expenses which I have booked in the first year, and this will be my answer. Is it clear to you? Your answer will be 82,87,500. In question number 4, it is given that an entity issued 50 shares each to 50 shares each to its 170 employees and subject to service condition of 2 years. The settlement to be made in cash and the grant date fair value of the share is 85. As you know, it is a case of cash settled plan. So in case of cash settled plan, actually we need to take care of this particular fact that fair value at the end of each year may be different from the one which is appearing in the beginning. So we have to take that into account. Anyway, the settlement to be made in cash and grant date fair value of the share is 85, and however the fair value at the end of the first year, second year were 80 and 90. So at the end of the year, fair values are given to you. You have to actually compute the expenses in this particular case. So in order to compute the expenses, first of all, take into account the number of employees. You are having 170 employees in first year. How much expenses you are going to recognize? 170 employees, each employee is entitled to 50 shares. So you are going to write here 50 shares and settlement to be made in cash. Now I'm not concerned with this grant date fair value because now I'm at the end of the first year. So at the end of the first year, the fair value is equal to rupees 80. So I'm going to multiply it with rupees 80. So in the first year, I'm going to recognize this much of expense out. Actually, the life period of the scheme is 2 years and we have reached the end of the first year. So this much of expense I am going to book in the first year. Is it clear to you? Now in the second year, again I will have to do the computation in this manner. 170 employees, 50 shares. Now the fair value is actually 90. So by the end of the second year, we will recognize this much of expense by the end of the second year. By the end of this shows expenses booked. This shows cumulative expenses. So by the end of the second year, I am going to recognize this much, but I will have to subtract the expenses which I have booked in the first year, and this will be my answer. Is it clear to you? So 4,25,000 will be your answer. And in question number 5, it is given that S1 Limited hired a maintenance company for its oil fields and the services will be settled by issue of 1,000 shares and period for which the service to be provided is 1st of April to 1st of July 2028. Only for 3 months actually, from 1st April to 1st July, only for 3 months we require the services. And the fair value of the service was estimated using the market value of similar contract is actually 1 lakh. And the nominal value per share is 10. So calculate the monthly expenses. Actually, in this particular case, what is happening, you are getting the services, correct? And against the services, you are offering 1,000 shares. You are offering 1,000 shares. Just to make the point, actually, employee benefit expenses, what will be, I should not write here employee benefit expenses, maintenance expenses, because in this case we are hiring services from a particular company for maintenance. So maintenance expenses account debit. To share capital, how many shares actually I am issuing them? I am issuing them 1,000 share and the face value of the share actually is 10. So it will be equal to 90,000. But at the same time, in this case, fair value of service is given. So I will have to record the transaction with this value. 1 lakh, that means total expenses will be considered as 1 lakh, and in order to settle 1 lakh you are offering what we call 1,000 shares of 10 each. If you have noticed, this question also was there in our module. Share capital account debit to security premium, and your security premium will be equal to 1,000 into 90. That is equal to this is equal to 10,000 and this is equal to 90,000. So this is the entry. Now the question is asking you, what will be your monthly expenses? Because this time your agreement is for 3 months only, April, May and June, till up to 1st July. So April, May and June. So during these 3 months, what will be the amount of monthly expenses? Now total expenses 1 lakh means 1 lakh is covering a period of 3 months. So I will have to divide it by 3 to know the monthly expense. So monthly expense will be equal to this much. Is it clear to you or not? Now we come over to what we call chapter 4, and this chapter, valuation of goodwill and shares. So as far as valuation of goodwill and shares is concerned, to be very honest with you, hardly you are going to be asked any question. Even in your question bank, not a single question out of this chapter is given as far as MCQ is concerned. But anyway, 3 major approaches for valuation of shares are Although generally we have a habit of what we call knowing intrinsic value method, net assets method, etc. But actually in practical life, these are the approaches: income approach, net asset approach, market approach. So your answer will be all of the above. Major basis of assets valuation for a going concern. Actually, this sort of question you will not be asked. Correct? In order to know actually whether a concern is a going concern or not, generally we take into account the book value, the replacement value, and the realizable value. So we may say that all of the above are the characteristics or the major basis for assets valuation of a going concern. The income approach for valuation of share includes the models or the techniques. Correct? In fact, all of the above will be the answer. Discounted cash flow, dividend discount model, maintenance profit basis. And similarly, some methods of goodwill valuation are there. Again, the answer will be this one, all of the above: capitalization method, super profits method, average maintainable profits method. So these questions should not pose you any difficulty. The ways of determining the value of goodwill using the capitalization approach. Actually, through capitalization approach, we can find out the what we call value goodwill either through capitalization of average profit. In it, if I am going to capitalize the average profit, first of all, I will get the capitalized value, and from there on, I will have to subtract the what we call amount of closing capital employed to get the amount of goodwill. Or we can directly get the amount of goodwill by simply capitalizing the super profit. Obviously, your answer will be C, both 1 and 2. Again, this is the chapter in your question bank. Not a single MCQ is given related to NBMC, correct? But just to have a bit of idea regarding this, non-performing asset in case of lease rental and hire purchase asset. So it is very important, and in the recently held actually revisionary session, we talked about all this particular point. So in case of lease rentals and hire purchase assets, how you are going to actually find whether it is a non-performing asset or not. If lease rentals or the installment remains due for a period in excess of 3 months, so that is important. Although you may not be asked such question, actually the term public fund include actually debentures, funds directly or indirectly raised from the public, and even the bank finance. So all these are considered as public funds. Third, Ind AS is applicable to NBFC on and from. Actually, most of you are not aware of this particular fact that even NBFC are now supposed to follow the Ind AS, and they have been made to follow it from this particular date, 1/4/2018. And this is a question, I doubt whether this question will be asked or not. All NBFC ND means non-deposit NBFC, which have asset size of 500 crore and above, and all NBFC deposit taking company shall maintain a minimum tier 1 capital of 10%. Actually, you will have to cram it, to be very honest with you, because most of you are not aware of this concept. Although in your earlier phases of education you must have gone through this tier 1 capital concept or tier 2 capital concept, I do not know. But anyway, right now you need to understand that all the NBFCs which are non-deposit taking one and which are deposit taking one and having an asset size of 500 crores or more, they are supposed to maintain a tier 1 capital of 10%. This sort of MCQ could be asked actually in the examination. Now, next one is related to your economic value added. Now, as far as economic value added is concerned, what is the formula for calculating economic value added? This should not pose you any difficulty, and you should be in a position to actually answer it without any doubt. Correct? Because we have seen when we did the economic value added chapter, first of all, we used to compute what we call economic value added. In order to find out the economic value added, first of all, we used to find out the NOPAT. Correct? Net operating profit after taxes. And once we have this net operating profit after taxes, from there on we used to actually subtract the cost of capital. And in order to subtract the cost of capital, we need to know the amount of capital employed or capital invested. Capital employed or invested, one and same thing. And then we used to multiply it with weighted average cost of capital, and this is how we used to get what we call economic value added. Correct? So you should be in a position to answer this particular question. And then we come across if you have net profit of rupees 1 lakh, invested capital of 50,000 and WAAC at 10%, what is your economic value added? Now it is already given net profit of 1 lakh, so this time you will take it as NOPAT, correct? And then you multiply 10% with this one and you get the answer. I need not require to tell you, I think most probably 95,000. Market value added is difference between. Now what is the difference between market? We did lots of question even with respect to market value added. Correct? If you remember, actually market value added simply shows the difference between the market value and book value. Let's see whether it is given in the option or not. Yes, here it is given that company's market value and book value of the share. In order to compute the market value added, we simply take into account the market value. But I told you while doing the question with respect to market value added that whenever you are going to find out the market value, never take into account the reserve and surplus. While when we compute the what we call market value, besides taking share capital, debentures, preference share capital, we also take into account the retained earnings or for that instance reserves. Correct? So difference between these two. Then there is a concept by the name of shareholders value added. Hardly 2-3 lines are given in your module. So you need to know, perhaps an MCQ may be asked. So shareholders value added represents the economic benefits generated by a business above and beyond the what we call minimum return required by all providers of capital. So this is what we mean by what we call shareholders value added. And similarly, value added. Now, what is value added? Value added can be defined by value created by the activities of the firm and less cost of bought in goods and services. If you remember, we used to compute the value added simply by first of all taking into account sales, then adding changes in stock to it, and then we used to subtract what we call cost of bought in material and services. So in this case, this will be economic value added. Again, now value added statement. Now we come over to value added statement. So first we'll take a break of 5 minutes and we'll continue with that and we'll finish it up. And I think how many pages have gone by? 17 pages have gone by. And I think near about 12 more pages are remaining, so we'll complete it. So now we take this chapter, value added statement. Now as far as value added statement is concerned, value added can be defined as we just saw. Actually, value added basically means wealth generated by an entity through collective efforts of capital providers, management, and employees. This should be your answer out of these options. That means answer A. Answer C, actually, I'm sorry. Answer C. Answer C, wealth generated by entity through the collective efforts. Which of the following is the advantage of the value added? Now, value added statement basically helps in judging the productivity of the company. Correct? And third, which of the following is deducted in value added statement in the value added section? In the value added section, actually, which you are going to subtract. Other income is not subtracted. Replacement reserve is not subtracted. Deferred tax account, it will not be asked, but it will also not be subtracted. In the value added section, question is asking. So that means your answer will be none of the above. Which of the following appears in the value added section in the value added statement? Obviously the depreciation. In the value added section, depreciation means, because that means we are talking about the lower part, gross value added applied. As you know, depreciation is considered as a sort of retained earnings kept by the entity. Now there is another chapter, financial instruments, and questions have been asked in the what we call examination from this particular chapter. The Indian accounting standard relevant for recognition, measurement, and disclosure of financial instruments are. In fact, when I started financial instrument in my regular classes and both in the revisionary session, in the very first session in the opening lines, I told you actually Ind AS 109, Ind AS 107 and 32 that govern the what we call entire accounting of Ind AS 100 of financial instruments. So that is why your answer will be all of the above. And then here it is written dash is a contract that evidences a residual interest. So it could be equity instruments only. Correct? Ind AS 109 deals with recognition and measurement of financial instrument. Is it clear to you? And then Presentation is basically dealt by Ind AS 107 and disclosure is dealt by 32. And then we are actually Indian accounting standard relevant for recognition, measurement and disclosure of financial instrument. In fact, again, the answer will be all of these. Financial assets are. Is cash is a financial asset? Yes. What is a financial asset? It is a contract. It is a contractual agreement whereby you are supposed to actually receive either cash or some other financial assets, correct? An equity instrument of another entity is a contractual right. So all these will be considered as what we call financial assets. Ind AS 109 financial instrument classifies the financial asset and financial liability into the following categories for recognition and measurement. As we saw actually, for the purpose of recognition and measurement, the financial asset or liabilities are categorized into three parts: FVTPL, FVTOCI, and what we call amortized cost. So your answer will be all of these. Redeemable preference shares should be classified from the company's point of view as a financial liability. Yes, it should be. Generally, because here it is written redeemable preference share, and that means there is an obligation. So if there is an obligation, you are supposed to classify it as liability. Now we come over to your theoretical chapter. Honestly speaking, you can manage it by yourself. Correct? You can do a self-study, but still choose the correct alternative. Which of the following is not a feature of government accounting? Reporting of utilization of funds is very much a feature. Government regulation is also a feature. Budget heads, again it is a feature. But as we know, government accounting is done on double entry system basis. So we may say that this will be the answer. Correct? So because it is written which is not a feature, so single entry system is not a feature. Further, it is written that which of the following is the objective of the government accounting. Now, as far as government accounting is concerned, it records the financial transaction of revenue and expenditure relating to the government organization. Yes, it is an objective to provide reliable financial data about the public funds. Again, it is an objective to record the expenditure as per the appropriate act, rules and legal provisions as set by the governments. In fact, all these are what we call objectives. So that is why your answer will be all of the above. Which of the following is not a general principle of accounting? Not a general principle of accounting. Classification of expenditure. Classification of expenditure is a general feature. Based on budget, again it is a general principle of government accounting. Cash basis of accounting, again it is a what we call general principle. Generally government accounting is done on cash basis, as we know. Quarterly accounting. Now, quarterly accounting, this is incorrect because it is not a what we call general principle of accounting. As we know that government accounting is generally done from 1st of April to 31st of March. Fourth one, audit of government account is done by, actually, the answer will be Auditor General Office. Yes. So it is done by Auditor General Office. And which of the following is the apex accounting body in the what we call Government of India? Your answer will be Controller General of India, who is considered as the apex body. Which of the following is not a software package used in the government account? Which of the following is not a software package which is used in government account? In fact, some of you might not know the software packages which are used by government. Gains and contracts are generally used, but here it is given Tally. Correct. Which of the following is not a software package used in government account? That is generally Tally. And then we have in this case, which of the following is not a part of government accounts in India? Now, we know that public account, contingency fund and consolidated fund are considered as part of government accounts in India, but RBI fund, that is incorrect. So in this case, your answer will be A, RBI fund. And here I have given you some extra points. These you need to take into account because MCQs can be framed from this. Actually, you need to know the titles of the Government Accounting Standard and Indian Government Accounting Financial Reporting Standards. So IGAS1 actually stands for guarantees given by the government and the disclosure requirements. Similarly, IGAS2 actually it stands for accounting and classification of grant in aid, and similarly IGAS3 that deals with loans and advances made by the government. IGAS 7 deals with foreign currency transactions and loans or gains and also with exchange variations, and IGS 9 deals with government investment in equity. IGS 10 deals with public debt and other liabilities of government. Now, rest of the standard IGFRS, actually it deals with presentation of the financial statement. IGFRS 2 deals with property, plant and equipment. IGFRS 3 deals with revenue from government exchange transactions, and IGFRS 5 actually deals with contingent liabilities and provisions and contingent asset. So MCQs could be framed out of this. Next one is corporate social reporting. Here from this particular topic you can expect actually MCQs. Choose the correct alternative. By which of the following is CSR reporting in India is governed? As we know that CSR reporting actually that is governed by Companies Act 2013. Besides that, even the company's CSR Responsibility Policy Rule 2014 also applies. So both will be the answers. So C, both of the above will be your correct answer. Which of the following sections of the Companies Act 2013 contains the provisions of CSR? Your answer will be 135. Section 135 of Companies Act 2013 actually contains all the provisions related to CSR. Third, as per Section 135 of the Companies Act 2013, minimum percentage of average profit that must be spent on CSR activities is 2%. Is it clear to you or not? For the purpose of determining the minimum amount to be spent on CSR activities, the average net profit must be calculated based on the net profit of the immediately preceding 3 years. Correct? The average profit must be computed, correct, of immediately preceding the 3 years. This is the question. Indirectly, it means as per Section 135, subclause 5 of the Companies Act 2013, an eligible entity must spend at least 2% of the average net profits which the company has made during the last 3 years immediately preceding the financial year. This is the point. Fifth, CSR committee to be constituted under Section 135 subclause 1 of Companies Act 2013 must comprise of at least 3 directors. And sixth, as per Schedule 7 of Companies Act 2013, which of the following activities qualifies for CSR spending by an eligible company? Correct? Eradication of extreme hunger and poverty, yes. Promotion of education policy, yes, and promotion of gender equality and empowering women. So all these activities qualify for what we are considered as CSR activity. And in fact, I have given you the names of all the activities here. Correct? You can go through this from this particular point to this particular point. So lots of activities are there. 8. As per Rule 8 of Companies CSR Policy 2014, which of the following item must be incorporated in the annual CSR report? So whenever an entity actually prepares its annual CSR report, it takes into account the brief outline of the company's CSR policy, and besides that, the composition of the CSR committee and prescribed CSR expenditure. So we may say that all of the above. So, and next one is XBRL, Extensible Business Reporting Language. This question has been asked so many times, what is the full form of XBRL? Unfortunately, I've seen that because in the examination you are tensed and there are anxiety levels is quite high, and in the heat of that, sometimes students commit unnecessarily mistakes. So your first answer will be Extensible Business Reporting Language. The full, and then today XBRL is used in. Those among you who have subscribed to our regular courses, they know actually that how deeply we have explained this particular chapter, so they should not confront any difficulty in getting answer to this. Today XBRL is used in accounting, correct, in internal reporting and external reporting. So we may say all of the above. Further, XBRL is, again this particular question you should not have any difficulty. I told you in my regular classes, basically it is an extensible markup language. It is an extensible markup language. Further, it is written, which of the following is not recognized as taxonomy? So which of these? In fact, here you will need to know that Indian insurance gap taxonomy is not considered as a recognized taxonomy. Correct? All other A, B, C are recognized taxonomy. And we have explained taxonomy at great details in our regular sessions. Which of the following is not true? XBRL is not a set of accounting standard. This is true. This is true. XBRL is not a gap translation and translator. Again, this is true. XBRL does not help in automatic data processing. Yes, this is not true. Which of the following is not true? Question says that XBRL does not help in automatic data processing. In fact, so this is not true, we may say. So this will be your answer in this particular case. XBRL is not a proprietary technology. So rest of the things are actually true, but this one is not true. So your answer will be C. Because XBRL data processing is done automatically, we know that. So that is why it is not true. It is not an automatic one. So which of the following, just wait. Which of the following is not a feature of XBRL? Now, those among you, as I told you, who have gone through this particular chapter, they know that actually clear definition, which of the following is not a feature of XBRL? Now, clear definition is very much feature. Testable business rules, it is also a feature of XBRL. But single language support, this is incorrect because it gives multiple language support. So your answer will be single language support. Strong software support, this is also a feature. And then here I have written which of the following is not a benefit of XBRL. More accurate and efficient, it is a benefit. You can review the data. This is again a benefit. Manual data processing. Now, manual data processing is not a benefit. So that is why this will be your answer in this case. And rest are considered as benefits of XBRL. So your manual data processing is not a benefit. Eighth, apart from those already covered by 2011 rules, which of the following classes of company need to file the financial statement through XBRL? All companies listed in India and their subsidiary, as you know, these are supposed to actually now file their what we call financial statement through XBRL. All companies having a paid of capital of 5 crores or more, and all companies having a turnover of 100 crores or more. So in fact, your answer will be all of the above. So any company in India which is a listed company, number one, and which is having a paid of capital of 5 crore or more, and it is having a turnover of 100 crore or more, must file its return through XBRL. Correct? And then here again it is asked, as per the company's filing of document and forms in extensible reporting language rules 2015, which of the following companies are exempted from filing their financial statement in XBRL? So those among you, as I told you, who have gone through this particular chapter should be in the know of the answer. As we know, banking company, insurance company, power sector company, all these companies are exempted from filing this return. Besides that, I have given some miscellaneous questions related to theoretical questions, and you can do it. I have already to do it by yourself. Answers in the bold. Answers are in the bold. So you can manage, and I will upload the notes also. So you can do the rest of 10 pages by yourself. Correct? So with that, we have covered each and every gamut of MCQs on popular demand. So on that note, I take leave of you already. I'm very tired today. It is almost 11 p.m. late in the night. But anyway, for you, we are putting lots of efforts. Looking forward to have your feedback as always, and wish you all the best and all the luck in the world. And we pray to the Almighty to give you supreme amount of success in the examination. Correct? So on such ground, I take leave of you. Shall meet you, and kindly actually let us know how you have done your paper. How was the paper? Whether you have done it well, or some of you might not have done well. So you must be honest in delivering your feedbacks. Kindly. Correct? So for that, we hope that each one of you come out with flying colors, as I have already told you, and we pray to the Almighty that it showers supreme success and you feel very, very comfortable facing the examination. On such count, we take leave of you. Shall meet you, as always, sometime else with some...